India's auto sector is facing a clear cost versus demand balancing act. Hyundai Motors India will raise vehicle prices by up to 1% from September, marking its third price increase this year. Tata Motors passenger vehicles will also increase prices by up to 25,000 rupees from September 1st, covering both petrol and diesel vehicles as well as EVs. Car makers say higher commodity and input costs, operating expenses and geopolitical disruptions are putting pressure on margins. Most manufacturers have absorbed part of these costs but are now passing some of the burden to consumers. Despite repeated price increases, demand in India's passenger vehicle market remains strong. Domestic passenger vehicle dispatches rose nearly 33% year-on-year in July to around 470,000 units, marking the strongest ever July performance. Hyundai recorded its best ever monthly domestic sales, up 23.3% from a year earlier. Mahindra's domestic sales jumped 58%, while Tata Motors say sales declined 11%. Lower borrowing costs, tax relief and GST-related measures have supported consumer demand. HSBC expects the sector to deliver mid-single-digit growth in the second quarter or the second half of this year, although further price hikes and a high base could test affordability. At the same time, Indian automakers are seeing a sharp expansion in overseas EV demand, particularly from Europe. India's electric vehicle exports surged more than 16-fold this year. Europe has emerged as the biggest destination, with Spain accounting for nearly $146.4 million in exports and the UK another $78.7 million. The export boom comes as automakers navigate supply disruptions, weather-related production challenges and rising raw material costs at home. The sector is therefore operating on two fronts, passing higher costs onto domestic buyers while expanding production and exports to capture growing global demand for Indian-made EVs.